Good morning, Bitcoin world. My name is Aiden Gillespie, and this is your guide on mNAV for Bitcoin Treasuries. So without further ado, let's get started with what is mNAV in the first place. mNAV is essentially a company's market cap plus their debt divided by the total value of their Bitcoin holdings. So their Bitcoin holdings can just be calculated by the amount of Bitcoin they own times the trading price of Bitcoin. A higher mNAV essentially means that there's a higher investor belief that a company can increase its Bitcoin holdings over time. And there also may be more leverage by the company that results in a higher mNAV as well. So let's take a look at Metaplanet, a stock that I have been making videos on for a little bit here, and a stock I really like. So they have a market cap of $7 billion, and their current debt is at $200 million. So we'll take the $7 billion, we'll add it by that debt, which is basically negative 200 million. So it's 7 billion minus 200 million. And then their current Bitcoin coin holdings is at 1.44 billion. So we'll divide that by $1.44 billion to get a 4.9 mNAV. So what does this mean? This essentially means that Metaplanet is worth $1.44 billion in terms of their Bitcoin holdings. However, the market actually values Metaplanet at $7 billion. So Metaplanet is essentially being valued 4.9 times higher what they're actually worth in terms of Bitcoin, hence the 4.9 mNAV. So Metaplanet is valued at 4.9 times of their actual worth in terms of Bitcoin because the market believes that Metaplanet will grow their Bitcoin over time to justify that premium, to justify that mNAV. So if you were to put money into mNAV right now with the current data here, for every $4.90 you put into Metaplanet, you are immediately getting $1 in Bitcoin exposure. So again, it takes 4.9x that money to get that $1 in that Bitcoin exposure. So another factor to keep in mind here is mNAV cover. mNAV cover is when a company is able to increase their Bitcoin holdings enough to essentially cover the mNAV that they were trading at before. So remember that mNAV equals market cap plus debt divided by the Bitcoin holdings. So essentially, when the company grows their Bitcoin holdings enough to equal out the market cap and debt they were previously trading out at, then that mNAV has been covered because the market cap plus debt equals the Bitcoin holdings. So essentially, mNAV would be 1. Now, it is important to keep in mind that just because a company has increased their Bitcoin holdings does not mean that's going to just directly drop the mNAV to 1. So, for example, with Metaplanet, if they 4.9x'd their Bitcoin holdings today, that doesn't necessarily mean that their mNAV will immediately be at a 1 if they 4.9x their Bitcoin holdings, because their market cap will likely be trading higher. So they'll still be trading at some premium. It will probably be a little bit lower than what it is today if they were to 4.9x their Bitcoin holdings. I'll get into why the mNAV would be a little bit lower, but it is important to keep in mind that just because the company is able to cover the previous mNAV that they were trading at a while back does not necessarily mean that they'll be trading at a 1 mNAV, because their market cap will be increasing as their Bitcoin holdings increase, as long as they execute their strategy properly. So now let's take a look at Metaplanet's mNAV cover. So Metaplanet is trading at an mNAV of 4.9. So Metaplanet needs to 4.9x their Bitcoin holdings to cover or justify this premium. So if Metaplanet holds 13,350 Bitcoin, a 4.9x in Bitcoin holdings would bring their total Bitcoin holdings to 65,000 Bitcoin. So if you buy Metaplanet today, once Metaplanet has reached 65,000 Bitcoin, you have essentially covered the mNAV that you bought it at. So when you originally bought Metaplanet, every $4.90 you put into Metaplanet, you only got $1 in Bitcoin exposure. But now every dollar you put into MetaPlanet get back then is giving you $1 worth of Bitcoin exposure, hence the cover in mNAV. So why would you invest in Bitcoin treasuries when you can just buy Bitcoin? So after you cover your mNAV, you can get greater exposure to Bitcoin than just buying Bitcoin alone. So for example, when we bought MetaPlanet at a 4.9 mNAV, it took $4.90 to get $1 in Bitcoin exposure. As I explained on the last slide, once they cover that mNAV, every dollar invested gets you $1 in Bitcoin exposure. But then if MetaPlanet were to double their Bitcoin holdings from there, every dollar invested then would get you $2 in Bitcoin exposure. So taking a look back at the mNAV calculations, so if MetaPlanet were to say get 130,000 Bitcoin, which would essentially get them about 10x of their current Bitcoin holdings, that would cover that mNAV, and then it would pretty much multiply it by 2. So their Bitcoin holdings are increasing far more than that premium that you originally paid for if they're able to get past that mNAV cover point. So another thing to keep in mind is that over time, mNAV will compress. There's a few reasons this happens. So one, as a company grows their Bitcoin holdings, simply covering a large mNAV just becomes harder. For example, if a company held 5,000 Bitcoins, investors would value that company more relative to its Bitcoin holdings to compare to if or when that company holds 500,000 Bitcoin. So, for example, investors may be willing to pay a 5 mNAV for a company when it holds 5,000 Bitcoin, because going from 5,000 Bitcoin to 25,000 Bitcoin to cover their mNAV seems attainable. However, when slash if the company reaches 500,000 Bitcoin, being able to cover a 5 mNAV would be extremely difficult, because that would mean that the company would have to go from 500,000 Bitcoin to 2.5 million Bitcoin to cover that mNAV, which becomes significantly less attainable. Another reason why mNAV will compress over time is that Bitcoin treasuries often dilute shares, which compresses the mNAV. So essentially what this means is that companies issue new shares to increase the total number of shares, which does dilute shareholders. Although this may seem to harm the shareholders, it can be done so accretively as long as they're bringing in more capital than they're diluting. So selling shares at high valuations allow Bitcoin treasuries to raise money to buy more Bitcoin. So that's why lots of companies do this. So when a company does this, they're essentially selling shares high, which dilutes shareholders, which decreases the share price. And then they can buy Bitcoin when the share prices are low. And then since their Bitcoin holdings increase, an increase in market cap becomes justified. So I'm going to pause real quick and go back to our equation. So when they buy the Bitcoin, this number right here on the denominator, their Bitcoin holdings goes up. Bringing that up will decrease the mNAV. Investors are going to say, hey, this is trading at a low mNAV. We think that the company can increase its Bitcoin holdings even more. So because that mNAV has dropped since their Bitcoin holdings has increased, the market cap will likely increase, because one, they bought more Bitcoin, and then two, raising that mNAV back up can become justified for investors. And then after that market cap becomes justified, the share price will increase, and then they can repeat that cycle by selling shares high again. So as long as the capital raised to buy Bitcoin outperforms the dilution of shareholders, this is accretive dilution and beneficial for shareholders in the long run. So as market cap increases, Bitcoin holdings increase, but because there is dilution, market cap does not grow in proportion to their Bitcoin holdings. So mNAV will slightly decrease over time because of this accretive dilution. So why would you buy a company if mNAV decays over time? Well, one, kind of like I mentioned before, you can acquire more Bitcoin with less capital. So again, going back to Metaplanet, if you were to buy Metaplanet when they're trading at an mNAV of 5, every $5 you invested, you immediately get $1 in direct Bitcoin exposure. If they 5x their Bitcoin holdings, you covered the mNAV, and every dollar you invested back then now gets you $1 in Bitcoin exposure. And then if they double its Bitcoin holdings from that point, you now have $2 in Bitcoin exposure for every dollar you invested back then. So you're essentially getting exposure to more Bitcoin than you would be able to get if you were just put in, say, $1 into Bitcoin as opposed to $1 into Metaplanet, where you could get $2 of Bitcoin exposure if this scenario were to have played out. So at that point, who really cares about mNAV compression? You would have exposure to 2x the Bitcoin you originally had, even if the mNAV dropped all the way to 1. So that would essentially mean that the market only values the stock to be worth its Bitcoin holdings. So if that were to happen, you still have the exposure to 2 times the amount of Bitcoin than you would have had if you were just to buy spot Bitcoin alone. So that's all I have for you guys. Thank you all so much for watching. If you have any questions, leave them down in the comments. And please consider liking and subscribing if you enjoyed this video and would like to support my work.